Financial markets have come under heavy pressure in October. Besides the US presidential election, the sharp rise in COVID-19 case numbers throughout Europe has also contributed significantly to investor uncertainty. Additionally, in countries that had come through the pandemic relatively well in spring, like Germany and Switzerland, the risk of negative economic growth in the fourth quarter is real. The new lockdown measures are weighing on the short-term economic outlook, at least in Europe. As a result, the services PMI has again fallen below the contraction threshold in recent months. The manufacturing sector, on the other hand, is doing much better in all regions. In China, whose economy was the first to go into lockdown at the beginning of the year, the PMI reached its highest level since January 2011, reflecting the strong rise in industrial production and exports. Although investors remain cautious within fixed income, the environment remains positive for credit markets. The prospect of further fiscal policy measures in 2021 and expansionary central banks are the decisive factors. Significant outflows from long-term US government bonds have led to a steepening of the US yield curve in recent months. This move is likely to reverse partially on the back of the split election outcome and the short-term economic challenges. With regard to equities, we have seen a number of conflicting factors. On the one hand, the third quarter earnings season has been surprisingly positive in both Europe and the US. On the other hand, rising COVID-19 case numbers cloud the outlook for earnings in Q4 and beyond. The soft patch in growth may again favor growth and quality stocks and is likely to delay a further rotation towards value and cyclicals. One segment which has outperformed in recent months is emerging markets, with China as a key contributor. In China, the COVID-19 pandemic appears to be under control and growth indicators are pointing higher. As a result of this positive fundamental backdrop, we continue to overweight emerging market stocks in our portfolios. So where do we stand with regard to our overall asset allocation? Although the danger of a second wave of coronavirus in Europe had been looming since the summer, the vehemence with which the number of cases shot up in recent weeks was nevertheless surprising. The partial lockdowns in Europe will soon lead to a peak in COVID-19 case numbers and bring comfort to investors that we will also get behind this second wave eventually. In addition, the US election will be resolved in the foreseeable future. Therefore, the level of uncertainty is likely to decline in the near future, which should be supportive for risky assets in general. Currently, our positioning is broadly neutral in equities. We are planning to increase our allocation to equities over coming weeks, as the expected return has increased in the last months due to the market correction in many market segments in October. Short-term concerns should soon give way to a more positive assessment for 2021, as an ongoing global economic recovery remains our base case. We remain underweight in government bonds. As the recent correction in equity markets has shown, the asset class offers little protection at these yield levels. At the same time, they bear the risk of price losses if interest rates start to rise even slightly. Investment-grade corporate bonds are more attractive due to stable risk premiums. We remain overweight in emerging market and high-yield bonds, as these are likely to benefit most from the continuation of the economic recovery in 2021. Overall, our multi-asset portfolios are well-balanced and diversified, which has served us well during this year and which continues to be crucial in coming months.